Howdy there, folks. Welcome into the buy one, get one free in this one here today. Two videos for me to react to. We're out of the bear market woods, but not in the clear for the bull market yet. I want to react to that one here 59 minutes ago. That one came out. I thought that would be an interesting one to react to. And then just a few hours ago, everybody's favorite bull on the markets, Tom Lee. The stocks are levitating because earnings season will be better than feared. So we'll hear what all the points Tom Lee has to make in this one, and I'll share my opinions and perspectives as always. Let's get straight into this, guys. I appreciate everybody joining me. 25,600 plus subscribers now on this channel. It's always going up. I appreciate y'all. Thanks for being here. Thanks for being subscribed. Glad you guys enjoy the channel. Let's get straight into this.
51 billion in inflows, so 26 billion in outflows. That tells you where sentiment really is towards investment products. And I think we've priced in this very ominous outlook already into the market. That's why I just don't think that going back and retreating to those October lows is credible without some form of an exogenous event.
Well, this is interesting. This guy, this is a Short Hills Capital guy. And it's interesting because he's, usually very bearish, very, from what it seems, short the market, right? But it was interesting because a few weeks ago, he kind of seemed like he went a little bit to the bullish side and capitulated a little bit. And that's just something we have been kind of seeing out with some of these more, I don't want to say perma-bear types, but some folks that are more over into that group. Some of them have been capitulating over this past month specifically. But then the banking collapse happened last month, and then they started to kind of go bearish again. Then the market started to go back, and they were like, oh man, maybe I was wrong for going bearish again.
We priced in, how have we priced in? We haven't even priced in a recession.
Well,
okay, sorry.
Ever our earnings, have we priced in an earnings decline from where we are now? We haven't really.
I think we have. I think we've priced in earnings are going to be down 7% on the quarter.
We haven't priced in,
I think
let's say,
valuations got ahead of that last year and saw what was coming, that there would be margin compression. You saw valuations correct in all equity sizes, classes, and strategies.
I want to make sure I'm clear on this because right now I'm not.
Okay.
You think that the stock market has priced in a recession?
Yes, I said that 4 months ago on Closing Bell with you. I say that again today. Stock market is priced in a recession.
I mean, when you look at the multiple expansion, right, you have to be convinced then that this is the trough in earnings this quarter because the multiples expanded to 18 times.
So $220 is the
So you know what that gentleman's missing right there? Trough in earnings for a lot of the biggest companies that matter the most in terms of weighting is in this quarter right now. And what you're going to see from countless of these companies, and specifically the biggest ones, is they're actually going to report better and better earnings as the year goes on, with actually really strong back halves of the year in terms of earnings per share. We're talking bottom line. I'm not talking about revenue growth. I'm talking about bottom line EPS growth. And the reason being is so many of these companies have done huge cutbacks in their workforce that hit them in fourth quarter and is going to hit them obviously in the first quarter and a little bit in the second quarter. But now their business is going to be streamlined. Meta's profitability is going to go to the moon in the back half this year. Amazon's going to, okay? I mean, if I look at just like the whole host of the most important stocks out there, I see their profitability increasing quite dramatically in the back half of this year. It's going to happen with a lot of small caps too. A lot of these small cap stocks got absolutely wrecked last year by inflationary problems, shipping costs, everything like that, trucking costs, everything. They got absolutely wrecked. Commodity costs, and all these businesses are seeing, shipping costs has fallen off a cliff, trucking costs have fallen off a cliff, commodities have fallen off a cliff. And so what you're actually going to see is from a whole host of companies report far better profitability. So we're going to go through a very strange time where, the revenue growth might not be very strong or actually weak. But what you're going to see is EPS growth way outpace the top line growth here. So it's going to be a funny time to go through. And you'll start to see a little bit of that in the second quarter, but you're really going to see it in the numbers in the third quarter and the fourth quarter of this year.
Right. And that 200 is not priced into the market. When the market goes up
because
4 months in a row, hold on, Jenny, when the market goes up 4 months in a row, I don't think it's priced in. If the market went down 4 months in a row, I'd say, yes, it's priced in. Have certain stocks priced in? Yes. Has the market overall? Absolutely not. I don't know how you can draw that conclusion.
Joe.
Hold
on, Jenny, I got you.
You're cherry picking your time frame. I think what the market correctly.
I'm talking about today. You're saying today.
The market correctly, during the course of 2022, priced in what was coming ahead, priced in the earnings recession. The market is a very efficient discounting mechanism, and I think the market did its job June, July, August, September, October, even into the end of the year with a lot of mega cap equities, and pricing in the environment where we would see earnings contract, enter the earnings recession. We certainly had the valuation recession. And I think the market has also understood that there's been this rolling recession, as Ed Yardeni keeps talking about, not a universal recession, that there are select industries that already are in recession.
Yep.
I don't.
100%. Everything there. Perfect. You know, sometimes I think these people forget that peak to trough, the NASDAQ was down over 37% last year. I think they forget that the S&P 500 was down over 20%. The Russell was down, 35% peak to trough last year. I think sometimes they forget that, right? I think they forget that many of the biggest, most dominant companies in the world, their stock prices fell 50, 60, 70, 80%. Did they forget Shopify fell that much? Did they forget Tesla fell that much? Did they forget NVIDIA, AMD? Like, go through all the most important companies that are growth beasts over this next decade and have been for the past decade, and you're going to find nothing but collateral damage out there.
Rolling recession's one thing, okay? And that's kind of a strange term, okay? Nothing falls off the cliff all at once, not every sector. So doesn't mean to me the rolling recession, if those companies seeing a recession, then they're going to recover in those sectors.
In 08, 09, it did actually. So it really depends. In the 2020 recession, it did. You know, I think this is a different time period. This reminds me a little more of the tech bubble-ish time period, and we had a small recession in the early 2000s. That's what this reminds me of, and that was kind of more of like a rolling recession, I guess you can call it, and that's what this has been. So, yeah, I'm in disagreement. You know, you saw a lot of industrials, a lot of basic material companies doing great last year, right? Oil and gas players, banks do great last year. And tech do horrible. This year, tech's doing great, and look what a lot of the other industries are doing, not very well.
Right? I think that
you can see a clear correlation. Pull up the NASDAQ versus the Dow Jones Industrial Average this year. Clear correlation in telling you the difference.
The others come down as well. And that I just go back to when the market multiple has expanded to 18 times, which is far above the historical multiple, I just don't see that as pricing the recession. Now, I agree with you that now we're not going to hit the old lows. I think that's completely out of the question. Is it 3,400? Is it 3,500? I don't know.
Now he just went. That's a more of a bullish stance there. We're not hitting new lows now. He says that's absolutely out of the question. Interesting perspective there from Mr. Shorthill's Capital.
I also don't believe we're off to a new market.
I didn't say that.
Bull market.
No, I didn't say that.
But if you priced in a recession already, what's the next step?
Because that's in fact why the market has had a 20% recovery from the fall. It's already priced in the worst case scenario.
Right.
No one is sitting here and advocating that we're going back up to 4,800. I'm not saying that. You need a tremendous amount of good feel in the market for that to occur. But I think the market has done its job.
Well, you're talking about price. You think the price has already marked the low.
Discounted, reflected.
And in fact, earnings as well.
It remains to be seen whether earnings.
So what's your downside? What's your risk reward in the market?
Jenny Harrington.
Thank you. I'm dying here.
Really? I couldn't tell.
Poor Scott. You need to manage me, and it's not
Please.
easy. So it's interesting because if you look at a chart of what the market multiple is based on historical inflation numbers, what you see is that we've steadily moved in exactly the right direction. So as inflation's moved from 9% CPI a year ago to 5% now, what multiple of the market so I don't think you should look at that historical multiple. I'm not sure that's the right way to deal with it. I think you need to say, when inflation's at 5%, what's a reasonable market multiple? And when you look at this data, you actually see that this kind of like 16 times to 18 times makes sense. I think Joe is completely spot on that in the middle of October is when we were really discounting $220 earnings. When I was on last week with you, Bob Pisani was on, and he showed us quarterly numbers for the S&P.
You're assuming if the $220 of earnings is the trough.
I think it is. And if you look at Bob Pisani's numbers by quarter, you see it's like $50 for Q1, $50-ish for Q2, and then they really start to pick up. And it seems like that's a more reasonable place to be heading. So I think we're heading to $240 earnings in 2024. You take that, you put 18 times on that, and it's actually kind of reasonable. But this is where I just want to get back to the Mike Wilson thing for one sec, because I don't think the right way to frame the question is, are we out of the bear market? I would argue that we are definitely out of the bear market. And to Jim Cramer's point about the market showing resilience, I would argue that we've been showing resilience since the end of October last year. So that time frame has been longer. I think the real question is are we in the clear with the bull market? Right. And like, if you look at a chart of the market, we've been so range bound. I'm not sure we're in the clear with the bull market, like really surging to new highs, but I think we're out of the woods with returning to October 2022 numbers.
Yeah, completely fair points. there she made. I just think the biggest thing that I think investors are forgetting, or traders in the market, or a lot of these Wall Streeters, I think the number one thing they're forgetting, to be quite honest, is the fact that many of the biggest companies in the world have done massive layoffs that are going through right now and started to go through in fourth quarter. And those layoffs are not just some, workers making $10 an hour or something like that. These are, workers making 100K, 200K, 300K, 400K a year, corporate workers, okay? And we're talking about billions of dollars of savings. We're not talking about millions of dollars of savings. We're talking about billions of dollars of savings. When you look at what Meta is going to be saving, Amazon's going to be saving, you go through a lot of these companies and you go through what their layoffs were and the cost benefit to that. It is astronomically high. And I just don't think there's enough, focus on that component. And that's just one of many reasons you're going to see EPS take off like a rocket ship for many of the biggest weights for the NASDAQ and even for the S&P 500 as this year kind of ticks on here. Tom Lee, everybody's favorite perma bull, is here. What Tom Lee has to say here.
Wall Street's brightest minds to share the word that they believe will describe the trading day ahead. Tom Lee, what is your WEX word of the day?
The word of the day is better.
All right, why? You got to explain that one. Just better? It's a little bit of a generic one, Tom. You got to give us an explanation for how it shapes the day.
Well, I think earnings season is underway, and I think the message we're going to see from companies is that results are better than feared, the economy is better than feared. That's a contrast to last year when everything was slightly worse than feared, whether it was inflation or Fed's reaction. And that better than feared is the reason stocks are kind of levitating, because you've got a lot of bad news priced in.
All right, Tom, you're a known optimist, a known bull for the market. You believe that we have a bit of a bullish setup right now, but I got to ask you, where's this all coming from? We're seeing the S&P only up 1% this month, the NASDAQ down almost 1%. What are the bullish signals that you're seeing?
Well, there's a couple things. Foremost, it's a seasonal positive because April is going to be probably one of the strongest months in 2023 based on what we call our rule of first 5 days. How the market performed the first 5 days has been a good template this year because it said February will be flat, March will be better, and April should be stronger. But one thing that's sort of starting to take shape is that over the last 20 trading days, about 65% of the days have been up. That's the highest percentage since November 2021. So while markets have actually bottomed in October, it hasn't felt very good because, in that period of time, the market's only averaged 45% of up days. But over the last 20, it's actually increased to 65. That's what you typically feel when you're in a rising trend. So I think over the...
Before we go further here, okay, a very important subject. Why does this bull market feel so bad? Why is it so hated? Okay, I think there's a few reasons for that. One is constant just negativity from the media, from social media, from everywhere the past 6 to 9 months, right? About it has to go lower, even 6 to 12 months we could say has to go lower, just the end of the world, all that stuff, right? I think when that's the perspective that you're getting constant kind of fed out there, a lot of people just start to subscribe to that. I think the second component of that is because inflation hit a lot of folks last year, right? Specifically a lot of retail traders that maybe are in the middle class or whatnot, right? It's not the best feeling if, let's say, you're not in the best financial position to feel bullish on the market, right? Because if you feel negative, then you're going to feel like about your own financial situation, you're much more likely to feel negative about the market, right? Think about that for a moment. I think another component of this kind of hatred toward this bull market that we're kind of slowly getting into here is just the fact that investors look out there and they of the assumption that because certain markets fell certain percentages in the past, we had to fall that much in this market, which just isn't reality. No market finishes the same. And a lot of people thought, this is going to be an 08, 09. And they thought, okay, we're going to fall, 50% plus in the indexes, and it didn't happen, right? And so therefore, a lot of people just kind of they subscribe to this thought process. And so there's just so many various reasons on why this is a very hated kind of bull market we're getting into here. And you got to understand, many times when you're coming out of a bear market and moving into a bullish one, it's going to be very hated. I mean, I can tell you, investors in the market were not bullish in 2009 for the most part, right? And yet we went into this massive, obviously, bull trend when the economy was still getting racked and continue to get wrecked for the next couple of years, right? And we continue to see housing weaken. And meanwhile, you saw stocks flying to the moon, and people were like, oh, just that's the way it is sometimes. And, the same thing can happen to bear markets when people aren't ready for the bear market yet. And right now, people aren't ready for a bull market mentally. Like people this last 6 months move, I think for most investors, they just haven't been mentally on that wavelength to go bullish yet. And so they see the market going up and up and up, and many of these stocks doubling up, 70% moves, 100% moves, 150% moves. And they're like, and it's a very uncomfortable feeling for, I think, a lot of folks out there.
Next couple of months, it's going to start to feel like a bull market. Of course, we actually do need everything to be better than feared, but I'd say that the setup is quite good.
All right, so the setup is good. So specifically today, where will we see signs of that bull market? I know you're bullish when it comes to materials and industrials. You believe that they're more attractive than healthcare is right now. But where will we see those potential bullish signs, especially today?
Well, I think that's really where the leadership has been coming from in the last month or so, as the four groups you just mentioned. But I think increasingly where people are worried about either financial sector stability or capital spending, the two groups to watch really in the coming week are going to be financials and technology. I think technology kind of sold off because we've had some curveballs like last Friday's Unish confidence survey, which showed inflation picked up, or the fears the Fed might have to do more. But again, if banks find stability, and so far bank results have been better than feared, I think you could see leadership coming increasingly from not only those four groups, but from financials and technology.
Okay, that's really interesting. And speaking of a curveball, we had Janet Yellen come out over the weekend saying that the banking crisis may serve the same effect as hiking rates, so maybe we won't need those hikes. Obviously, she's not part of the Fed. She's the Secretary of the Treasury. But what does that signal to you about what we might see today? Is that going to give the markets perhaps more confidence that a pause could be on the way?
I think investors should interpret that as a pause coming because, largely I agree with her observation. Financial conditions are tightening because regional banks and banks in general have been cautious, but now you have an additional sort of pressure on their cost of money, which is going to reduce lending. That is exactly what monetary policy is trying to achieve, is to slow the economy. So is the Fed doing hikes on its own? At this point, not. It's not, because as it's doing its hikes, there's also this additional element of credit tightening. And that's probably why the pause argument makes a lot of sense.
Okay. So you, again, see the markets adding this month, at least the S&P adding to its about 1% gain. Today, where will we see signs of that? I'm going to ask you again. Are you seeing any area today that we could see some signs of this bull market you're expecting?
Well, it's going to just come down to earnings season, because that's really going to be the catalyst. And we're only early in the earnings season. Only 32 of the 500 S&P companies have reported. So the next couple of weeks, Frank, is really going to be kind of company-specific earnings that are getting delivered. Last week was the banks, and now we start to get some of the larger industrials and some tech.
Okay, you mentioned tech. We have some big tech earnings coming up this week, Netflix and Tesla. What are you expecting from them? Could they potentially be a catalyst for the NASDAQ to reverse this month?
Yes. That's always, that's kind of how earnings season played out 3 months ago. It's going to be, our company's going to surprise us on the demand side. I don't know if Tesla and Netflix necessarily singularly move the markets, but their individual performance is going to be important to watch, because at the end of the day, these are widely held names. So, let's hope for the best.
I hope for the best. Yeah, well put there, Tom. So anyways, I appreciate kind of hearing his thoughts. Inflation is I was going through commodities while he was talking there, because he did mention inflation. And if you look at true-flation numbers, we've seen an uptick over the past few weeks in inflation. We got down to the 3s as far as true-flation went, but now recently we're back into the 4s. And so, we got to keep this, let's call it this ride going, right? And we got to keep it going lower, not higher. And so if we can see true-flation numbers get back down to 3s again, and then hopefully get down to the 2s this summer, we'll be looking really good, because that means we'll likely be seeing 2s and 3s at some point in time, maybe late summer, early fall, in the government numbers, if true-flation's kind of taking us there. So let's hope that happens. But, for now, it is what it is. Appreciate everybody joining me. As always, much love. Thanks for being subscribed. If you're looking to apply to join my private stock group, the private wealth group, and you want to join us in there this week, check out the description area. It'll be down there. If you're looking to join my Patreon, you want to support my content, support the channel, that'll be in the description as well. Have a great day.